Good evening, and welcome to the latest webinar in our Financial Wellbeing for Women series. My name is Rachel Winter, and I'm one of the investment managers here at Killick. This week is actually Pensions Awareness Week, so happy Pensions Awareness Week. We thought it'd be quite a good time to focus on planning for life after work with particular emphasis on pensions. Pensions is definitely one of the areas that our clients ask us about most frequently. And we did do a webinar about pensions last year, but we just thought a refresh would be a good idea for a number of different reasons. So one is that pension regulation is changing all the time. One is that stock markets have actually moved a lot in the last year. And the final one is that a lot of people's financial plans have been quite heavily impacted by the rise in the cost of living that we've seen recently. Now, saving for retirement has always been a trade-off between the present and the future. So whatever you spend now is not going to be available for you to spend in the future and vice versa. And with costs going up, many people are facing quite difficult decisions about their own retirement savings. And actually, Killick commissioned some research a couple of weeks ago that looked at how the rising costs of living are impacting the transfers of wealth between different generations. And that research showed that about 30% of women are either accessing or considering accessing their retirement savings early because of the current cost of living problems. So clearly retirement saving is very topical at the moment. So we do hope that you'll find this webinar very helpful. If you have any questions throughout the webinar, please pop them in the Q&A box at the bottom. And at the end of the webinar, we'll do our best to get through as many of those as possible. I'd now like to introduce two of my colleagues. We've got Sarah Hollowell, Director of Tax and Trustee Services at Killick, and then Bronwyn Horton, one of our financial planners here at Killick as well. So a good place to start then is probably what actually is a pension. We're not taught this at school, and it is quite a complex topic. There are many, many different types of pension. So over to you, Bronwyn, if you could give us a summary of the different types.
Thanks, Rachel. So there's a huge number of ways that people can actually fund life after work. And like you said, tonight we're really going to concentrate on pensions as one of the main methods. So yes, I'd like to really start with a quick overview. And this is a whirlwind tour of pensions, just to give you an idea of the different types and a lot of sort of jargon that we use in the industry. So the first one is the state pension. Now, there's a little bit of a misconception that you start receiving the state pension from age 65. The age has increased recently to age 66. It'll continue to increase to 67 between 2026 and 2028. Now, it's also scheduled to increase to 68, although the time table hasn't been released. Now, entitlement to the state pension really does depend on your national insurance record or your contributions to it. And to qualify for the full amount, which is currently £185.15 per week, you'll need 35 full years of contributions. Now, if you don't have this, what you're going to need is at least 10 and over to receive a pro rata amount. Now, there's a couple of ways that you can check that, and we will make sure that we send out the links. First is the age of eligibility. So we'll send out the government website for that. And then how many years you've actually accumulated. So you can actually check your state pension forecast. Now, this will actually show you any gaps in your contributions, and it is possible to fill those gaps, but there are restrictions. Now, I won't go into all of that tonight, but there are a few ways of doing that. Now, for many people, the state pension of sort of just over the $9,600 a year is not going to be enough for the actual living costs, so they will need to subsidise this. And like I said at the beginning, with pensions, there's so much jargon, and often many terms are used for similar types of pensions. So I'd quite like to cover just a couple of those tonight. So firstly, there's two main types of pensions. The first is what we call a defined benefit pension. And this is often referred to, and I might use that tonight, as a DB pension. They're also known, just to make it more confusing, final salary. They might also be referred to, depending on the type, as a career average pension as well. And then the other main type, which sits alongside this, which I'll come to in a minute, is what we call a defined contribution or DC pension. Now, the DB or defined benefit is an older type of pension where on retirement a person would receive a set amount which could be adjusted for inflation for the rest of their life. Now, these are becoming few and far between. Now, the second type, which I mentioned before, a defined contribution, this is also known as a money purchase pension or a personal pension. Now, how these work is that your pension pot, when you come to retire, is solely made up of what's been put in and how it's performed. So once you start drawing, you can actually end up winding this right down to zero. So for some people, they could actually run out of money. Now, both of these are classified as what we call workplace pensions. So these can actually be set up through work where an employee and an employer make contributions in. However, the employer might cap how much contributions they put into a pension and may not allow for any sort of additional contributions. With auto-enrolment, which began in about 2012, both an employee and an employer need to contribute a minimum of 8%. Now, mix of how that 8% is made up can be 3% employee, 5% employer, or the other way around. So many people also have opted for holding personal pensions, which are usually defined contribution pensions and can allow for additional contributions to be made, which we'll discuss later. The final one that I just want to touch on, and there are a number of others as well, but we do talk about it later on, is what we call a SIP or a self-invested personal pension. Now, this is a type of DC pension, and depending on your provider, you may have a range of options of what you can invest in. But yeah, hopefully that's sort of covered all the main areas.
Thanks, Bronwyn. So obviously these defined contribution pensions are really important, and that word contribution is particularly important because the value of the pension depends on how much we are contributing. So is there a limit to how much people can put into these types of pensions?
Yeah, so firstly, again, a little bit more jargon that I'd like to sort of really go through. Firstly is the annual allowance. Now, this is how much an individual can contribute, and it's capped at 40,000, and that's the amount that you can actually then obtain tax relief on. Initial contributions will attract 20%, and then you may be able to receive further in other circumstances. Now, Sarah will cover that a little bit later. And what you can contribute is also dependent on what we call your relevant earnings as well. Now, you may have heard of the term too, carry forward used. And many people decide to actually contribute or top up their workplace pension when they're in a position to do by making additional contributions to their personal pensions as well. Now, what tends to happen there is when their income allows it, they may be able to look back over the last the previous 3 years and carry forward that annual allowance as well. But again, this is restricted to your relevant earnings as well. And then the third area that I just want to tap into as well is the tapering of the annual allowance. So not everyone has that 40,000 available. So since April 2020, people with a taxable income of over 240,000 have had their annual allowance restricted, which means that for every £2 of income over that 240,000, the annual allowance is reduced by £1. So that means that the maximum reduction there is down to 36,000 that somebody could. So basically, they could only have an annual allowance of 4,000 if they've got the income over 312,000. So therefore, people with higher incomes are caught by this restriction and really have a reduction in their contributions, both that they can put in and their employer as well. So when it comes to carry forward calculations or tapering, it's really important to seek advice.
And Bronwyn, one of the reasons why pensions are so complicated is that the rules seem to change so frequently. So are there any changes to the rules that have happened in the last 12 months that you think people need to be aware of? And perhaps more importantly, we've got the budget coming up in the next couple of weeks. So do you think there are any areas of focus that will be featured in the budget with regard to pensions?
Absolutely, and you've touched on it. I think the whole area of pensions, I think this is why people find it so complex, is that it does go through regular changes. So state pensions have been all over the news over the last couple of months. This is because of the current high inflation environment which we find ourselves in, and something called the triple lock. Now, before tonight, we had a number of questions about could we explain what this is? So the triple lock is the mechanism used to increase the amount of those who qualify for the state pension on what they actually receive. Now, to ensure that the state pension rises in line, it is usually the highest of three key factors. So firstly, is it the highest of 2.5%? Or is it the average wage growth as well, compared to the previous year? And also to inflation. Now, it's inflation that's caused a lot of discussion of late. And so Rishi Sunak's predecessor had been committed to raising the state pension in line with inflation. Now, the Bank of England have come out and said this could peak at 11%, but unfortunately she resigned as Prime Minister the following day. So it's potential that there's another government U-turn. We can't rule it out, really. So if we look at the rates at the moment, so for the 2022-2023 year, so the full state pension rose by 3.1%, which took it, and I mentioned that before, the 185.15 a week, or 9,627 a year. So we'll be watching really closely in the autumn statement on Thursday the 17th, really to see what happens there. I think the second concern that's sort of been discussed a lot lately is, again, around this concern of high inflation impacting the cost of living. And that's where, the stats that you said at the beginning really do impact and come into play. Now, the reason for this is that we had pension freedoms come in April 2015. And this allowed people to have a lot more ability to access their pensions and a lot more flexibility as to when they sort of access those. Now, the concern here is that the money is really meant to be there for their retirement. And if they're accessing pensions often and in large amounts, their pension pots may not have time to recover and may be quite depleted as well.
Thanks, Bronwyn. So Sarah, I think it's probably about time we brought you in. With pensions, there are lots and lots of different tax considerations. So could you give us a summary of some of the main ones?
Yeah, sure. Well, saving into an approved pension scheme is really effective from an income tax perspective. All contributions you make receive basic rate tax relief when you make the contribution, and you don't have to do anything at all. This relief is given by the government, adding 20% to whatever you pay in. And that's as long as your contributions are within the annual allowance that Bronwyn mentioned. So an £800 contribution is grossed up to £1,000 once the tax relief has been added. Then if you're a higher rate taxpayer or an additional rate taxpayer, you then get further tax relief, which you have to actively claim by your self-assessment tax return or by notifying HMRC. So higher rate taxpayers will claim a further 20% and additional rate taxpayers will claim 25%. And because you must actually make the claim yourself, some people miss out. And it is possible to backdate a claim for higher or additional rate tax relief, but there are strict time limits. So if you haven't claimed the relief previously, you can claim for a maximum of 4 years. Then once money is invested within your pension, all income it produces is free of income tax, and there's no capital gains tax on the disposal of assets that are made within the pension wrapper. And you should be aware, though, that if you are transferring assets in specie into a pension, and that means if you've got some shareholdings in a nominee shareholding or in your own name, that's an in specie transfer if you move it as it is into the pension fund. These transfers are treated as deemed disposals for capital gains tax purposes. So if the value of those assets has increased since you've bought them, you could end up paying tax on them without actually receiving any proceeds. So you just have to be a bit careful there. So the income tax side of things and the capital gains tax side of things within the pension is obviously a positive, but Bronwyn mentioned the tapering of the annual allowance, and this can result in a complex calculation being needed to work out how much you can actually pay into your pension. And particularly it's even more complex when carried forward allowances are taken into consideration. Exceeding the allowance can result in a tax charge, which most people don't want to do. So we'd always recommend that you speak to a professional if you're unsure how much you can pay in during a tax year, just so that you don't end up with an unexpected bill. So obviously, Rachel, we spoke about the fact that pensions and so on are really effective for tax purposes, and because there's no income tax on the investments, that can be really good for performance. So could you talk about the control over investments and stuff that goes on with the pension?
Yeah, absolutely. So performance is a really important thing to consider for pensions. And as you alluded to, if you are investing outside of a pension, any dividends that you receive would be taxed, and you would have to pay capital gains tax on any profits that you make. Whereas inside the pension, you're not paying those two taxes, so you are likely to get a much better performance. So with a defined contribution pension, you've got your own pot of money that will be invested in the stock market. So the performance of that pot of money will directly impact the amount that you'll have to live on in retirement. So you really want it to grow as much as possible and to perform as well as possible. And over longer time periods, the level of performance can have a massive impact on the amount that you'll have in retirement. Because if you're just starting work, maybe you're in your mid-20s and you're starting to contribute to a pension, you probably won't be able to touch that money for 30 or 40 years. So the difference in performance between a bad portfolio and a good portfolio could be absolutely massive. So it's really important to have a look and see what your pension's invested in and what the performance is like. And at the very least, you really want to be beating inflation over the longer term. So the money that you're putting into your pension will maintain its spending power over the longer term. Now, you will have a degree of control over the investments that are held within your pension. It can vary from platform to platform. With some pensions, you would be able to select your own choice of fund from a fairly limited list of funds, whereas with some other pension platforms, you would be able to invest in a much wider range of investments, including individual shares. So Bronwyn mentioned SIPs earlier, which is the self-invested personal pension. And with those, you do have a much wider range of investments available to you. But just generally speaking, it's really, really important to have a look at what you've got in the pension. If you're worried about the performance, do consider making a change. You could also consider consolidating pensions that you might have in different places. So these days, it's quite common for people to move jobs every couple of years, and we do meet a lot of clients who do end up with, maybe 5 or 6 or maybe more pensions all scattered all over the place. And actually, you could consolidate them, have all the money in the same place, and that will enable you to have a more coherent investment strategy across that one pot of money. And also, it would be much easier for you to keep tabs on as well.
Brilliant. Thank you, Rachel. And what sort of considerations do you sort of consider when putting together a portfolio for a particular client? You sort of mentioned, all these different sort of investment options, but yeah, what are sort of your main considerations there?
So I think one of the most important things is what is the right level of risk for a particular client? And the right level of risk will be different for different clients. Partly it will depend on what that particular client is comfortable with. But a big factor in the consideration is the time horizon. So if someone has a long time until they need to touch their pension, then arguably that person can afford to take much more risk, because markets do go through cycles, they do rise and they fall. And I often say to clients that the market has recovered from every single crash that's ever happened. You just need to be able to remain invested to wait for that recovery to happen. And for example, if we take this year, it's been an awful year for markets. If you've got a portfolio that's invested in global stocks and shares, it's very likely that you're down over 20% over the course of this year. But if you're someone who's got quite a long time until retirement, and you're still adding money to your pension every month, then actually you're probably benefiting from the current market fall, because you're currently buying investments at a much lower level. So over the longer term, having periods of market weakness can actually be a benefit. What would be a concern would be if you had a portfolio of stocks and shares and you wanted to take your 25% tax-free lump sum this year. If that was the case and you'd lost 20% of the value because of weak market performance, that would be a real problem. So normally, as people approach the point at which they want to start taking money from the pension, that's when we start to lower the risk. So the time horizon is a really, really important consideration for us. So having control over the investments in your portfolio and having control over the level of risk is a really good benefit of these defined contribution pension schemes. But there are several other benefits. So Sarah, I think you had a few that you wanted to talk through.
Well, the biggest positive really is that you have the ability to leave your pension pot to a beneficiary or beneficiaries of your choosing. The tax consequences depend on whether you die before you reach 75 or afterwards, but the main benefit is that you can pass on the money to whoever you wish. I should mention, though, that pensions are not covered by your will, so please ensure that you complete relevant nomination of beneficiary forms with your pension providers, and it's then a good idea not to just leave them there in their filing cabinet, but to review them each time your beneficiary circumstances change or your circumstances change. You might need to leave the pot to somebody different and maybe even skip a generation. So it's always something to think about, but that's something that you should always do if you have a pension. So after thinking about what to do with your pension after you die, Bronwyn, how should people get started with pensions, and do they always need advice?
That's a good place to start, isn't it? And so I think Rachel mentioned earlier that, you know, we do see a lot of clients with pension pots all over the place, and actually, you know, come out with ones that they maybe had forgotten about because they've moved house a few times. So firstly, I would always say, if you do think that you've got previous pensions, go and locate them, and we'll make sure that we send out the government link to find the way to find pensions as well. I think once you've located them, or dig out all of your old paperwork as well, or electronic statements as well. So have a look at their annual statements and see effectively, there should be an estimate of what you might be potentially entitled to in retirement. And like Rachel said, have a really good look at actually what's been invested in. What are your restrictions as well? Because there are some that can be quite restrictive as well, and actually, might not be in your best interest as well. So it's really important that you do have a good look at them. Now, when it comes to seeking advice and putting a good financial plan in place, the rule of thumb that we always work to is go and seek advice when things start to get complicated. Now, this may mean when you do have a number of pensions, a number of types of pensions, and you really want help to sort of look after those or consolidate those. Seek advice also when you want to make additional contributions. You may have additional funds from savings or inheritance or a bonus, and potentially you need to use a carry forward, which we mentioned earlier. So the calculations can get quite difficult as well. Another situation is where somebody is coming up to finishing work. Like Rachel said, and Sarah as well. When you are coming up to actually taking that money, and the markets are not great, what's the best then drawdown strategy for you? So we see that a lot, and also too, which pots or pots of money should you really start looking at first? So I think that's really important to seek advice. One term that you might come across is what we call the lifetime allowance, and this is really a cap on how much individuals can contribute into their pensions. So while this is a complicated area, the reason is because it's changed so often over the last few years, and also too, we've had quite a lot of market fluctuations as well. So there might be a number of different sort of reasons that somebody needs to get their LTA assessed as well. We do also have a number of really good guides, which we'll mention at the end, and we'll send around the links as well so that you can download. And it might help some of these terms and a bit of the jargon as well, and sort of help to clarify when you might need to speak to a professional as well. We've really focused and mentioned tonight a lot around employed people, But when it comes to self-employed and business owners, they potentially have a lot more flexibility and a lot more control over their income. So there's a potential there for planning as well. And then the final area is, like you said, Sarah, before, is passing down wealth to other members of the family.
So is it ever too early or too late to think about pensions?
Yeah, I think Rachel mentioned that before. With somebody starting out, there's never a too early time to start. The earlier the better, because it gives your investments a lot longer. You've got a lot, much longer period to grow and take go through market cycles as well. So usually it's your first job. However, parents or guardians can actually set up what we call a junior SIP, so a junior self-invested personal pension, and they can contribute up to $3,600, including the tax relief, which we spoke about earlier. So this is quite a good way for people to start building up, retirement funds for their children as well. Now, it's also never too late to either start over or get started as well. So some considerations for people who are may have had time out from work. Even if you're not working, you can contribute that $3,600 every year, and you can do this right up until age 75 as well. I usually use a cash flow to help people as well really visualize what their money's doing. So I recently worked with a couple who are coming up to age 60, and they had been pensions all over the place, but also to a quite a big sort of buy-to-let portfolio as well of rental properties, and they really wanted help to actually work out what they were going to do, because their liquid funds were actually quite low, and they were really concerned about retirement. So what I'd like to do now is really just share my screen and show you visually what a cash flow model looks like, and what we can actually or how we work with clients as well. So let me just go through this. I'll just take a minute to bring this all up as well. It won't be a minute there.
Just to chip in while you're doing that, Bronwyn, if anyone's got any questions, just pop them in the chat at the bottom, and we'll have about 10 minutes at the end to go through those for you.
Perfect. So hopefully, Rachel, my screen is displaying there with what we call our cash flow model.
Yes, it is.
And quite colourful and lots of red, which usually flags up a little bit of warnings. But you can see here, this is what we do, is we extrapolate out what people have. So what assets, what pensions they have, what income's coming in. And you can see their ages down the bottom. There's a pre-retirement, so they're still working at the moment. And then you can see that there's what we call an expenditure line, which is the black line that goes sort of through. You can see from about age 90, 89, it really does jump up. And what we've done here is we've factored in the cost of care for people. So really, it's about making sure that there's enough money down the track for covering all expenditure through retirement while you're not working, but actually later on in life when you need to cover these expenses. Now, everyone is different. So what we do is we try to make sure that we've factored in, so lots of people's, sort of considerations. So you can see here that that there's an orange section in the middle from age starting from 72, and this is what they thought they were going to do, was tap into their pensions. But you can see that their pensions actually stopped at around sort of 77, 78. Now, the light purple at the bottom is still their rentals, which they're receiving from some of their rental properties. The dark blue is their state pension. So you can see there that actually doesn't make up too much of their money, but it's still important. So they sort of said, how are we going to sort of cover these costs and everything? So let me just take you down to the next one. I'm just seeing that the actual display is not very good on this one, so let's go there. And so then we move on to what sort of assets they had. And you can see there that the purple down the bottom is all their property. So you can see that they've got their main residence in there and quite a few properties, but you can see the money up the top really runs out quite early. So they don't actually have anything to sort of, pay for their retirement. And they were really concerned then about having to liquidate. And what about the timing of that? Because when you think about liquidating property, it does take a long time, and they might not be able to find buyers, and they were really concerned about this. So this is what it looks like. This next one is actually after planning. So after sitting down with myself and our investment team, this is what it looks like now. And you can see there that at age 66, this yellow sort of spike there, that they actually decided to liquidate half their properties and invest it and change a lot of their pensions as well. And you can see that we actually removed a lot of the shortfall later on in life. You can also see that they don't actually start tapping into a couple of their pensions until the last couple of years. And this comes back to what Sarah said, and when she said actually it's quite a good tool to actually pass this, be able to pass wealth down to the next generations. And so then finally, this is what their assets look like towards the end. So they definitely had enough money. And there was also a little bit of, a couple of $100,000 in pensions that they could then provide to their family as well. So that is just a bit of a view of what we do with clients and using the cash flow tool. It really is about aiding a discussion with people and actually sort of trying to see how long the money will last, because there's so many factors that we need to take into consideration. But it is really important that we think about all of these things throughout our lives as well.
Brilliant. Thanks, Bronwyn. It's really helpful to see that visually. So we're just coming up to about 5:35 p.m. now, so we've got a couple more points to consider, and then we'll just move on to questions. So final point for you then, Sarah. We've talked a lot about pensions, and clearly they are a very, very important part of our retirement planning, but are there any other things that people should be considering as well?
Thanks, Rachel. Well, it goes without saying that everyone should be looking at doing a will, and this needs to be reviewed as you approach retirement. But one thing that people tend to avoid thinking about is who should look after their affairs if they're unable to look after them themselves. It's no fun to think about it, but it can save a lot of heartache and worry for those closest to you if you put lasting powers of attorney in place. And the main thing is, don't leave this too late. Do it when you start planning. One of the main reasons really at the moment is the Office of the Public Guardian is currently asking you to leave up to 20 weeks for an LPA to be registered. And our own experience is that it can take even longer, and so much can happen in that time. Then when you have put LPAs in place, make sure your attorneys understand what their obligations are. Some people mistakenly think that the attorney simply steps into the shoes of the donor, but that really isn't the case. They always have to act in the donor's best interests and act in accordance with the terms of the LPA. And also, what a lot of people don't realise is that they should actually help the donor to make their own decisions if possible, rather than simply taking over. So sit down with whoever you decide to appoint to look after your affairs and talk about it with them properly, so they know what will be expected of them. And it's useful, of course, if they've got some knowledge of exactly what they're going to be dealing with, rather than having to wade through a really untidy filing cabinet.
Great, thank you. And just to finish off with, I'm just going to ask you both, if you had one top tip that you'd like our clients or prospects to take away with them, what would that be? So Bronwyn, I'll start with you.
So a couple actually, because I can't just do one. Don't be afraid to ask if you don't understand. So if you do have an existing advisor, planner, investment manager, please do, if you don't understand something, they will take the time to sit down and really talk you through things so that you understand. And don't, just keep learning. Make use of free resources. I'm just going to highlight our ones here, which we'll send out the links to. But we really do focus on education here, and it's really useful just to while there's professionals there that you can use, it's really good for you to understand really what's going on as well. So that's my top takeaway.
Great. And Sarah, your top tip?
Well, mine really is make sure you claim back all the tax relief that you're entitled to, and within the time limits. And if you don't know how to do it, approach a professional for help. It's worth paying somebody to get some money back, rather than letting the government just sit on it and keep it for you, because they're not going to say to you, okay, you should have had this tax relief. You really have to actively claim it yourself.
Great. And then just one from me. I just wanted to touch on market performance over the last year, because obviously it's been a very volatile year. A lot has changed. We've seen quite big falls in shares and also bonds, and there's been quite a big divergence in performance between different sectors. So, for example, the technology sector has been quite weak, but the oil sector has been quite strong. So if anyone wants to understand a bit more about what's happened in markets over the last year and to understand a bit about what we're focusing on going forward, our research team and our Chief Investment Officer are doing another webinar next week with their thoughts on the market. So for anyone who's interested, I think that would be well worth a watch. So that's my tip. And that just about brings us up to the end of what we've got time for. So we'll close out there and we can move on to questions now. So for anyone who does have questions, just pop them in the chat at the bottom. And we've got about 10 minutes to spend on those now. So I'll give you a few minutes then to write your questions out. Oh, I can see we've got some already. Let's have a look. So question 1, with regard to passing on your pension pot after death, what is the significance of living to or beyond the age of 75?
Do you want me to tackle that one, Rachel?
Yes, that would be great. Yeah, please do. Thank you.
Right. So age 75 is quite an important age. So if a person does pass away before age 75, then their pension can pass to their beneficiaries tax-free. Now, living beyond 75, that then means that the beneficiaries, they still receive the pension, but they have to pay at their marginal tax rate. So it's quite important, the distinction between the two.
Great. And next question. I have a SIP invested with Killick. Do I have to nominate my wife as a beneficiary, or is this done automatically? Probably Sarah, that's probably one for you.
It won't be automatic. You will need to complete a beneficiary information form or a nomination of beneficiary form. So if you haven't already done so, or you might have done so when you first signed up, I would just check with your investment manager who's looking after your SIP just to see if they've got one on the system for you, because they'll be able to see it. And if there's not one there, just make sure it's filled in.
Great, thank you. And Bronwyn, this is one about the cash flow that you showed. Why the spike in expenses after the age of 90?
Yeah, so as I mentioned, so the expenditure was quite sort of steady throughout because that sort of set it at a particular area. But at 90, what we do is we factor in the cost of care. So somebody needing to go into residential care, and we usually factor in 3 years of that, and then 2 years of nursing care. And the nursing care is a lot more expensive. Now, for some people, it's really important that they stay in their house. So that's why we sort of factor in maybe not selling property, but that could be an option for them. Others decide that they actually want to have a carer come and live in as well. So we just adjust those costs there. But it's really important that people don't forget that, you know, that they're sort of sometimes in our minds we think, oh, we might 20 grand for, you know, for the rest of our life, and you know, we do the math and we think, okay, yep, I can cover all of that, but we don't think about, you know, that last bit of cost of care.
Thank you. And then, can you pass on a state pension, or does it die with you?
So yeah,
Bronwyn, probably another one for you, I think.
This one very much depends on when you started really drawing on your state pension and what it's made up of. So I really, it is something that, yeah, go and have a good look at, get your pension state forecast and go from there.
Nice. And then the final question, unless anyone has any more they'd like to type in, what does crystallizing your pension mean?
Another one.
Bronwyn, it's you again. Busy day for you.
Yeah, so this term is really interesting, and it does sort of confuse people a lot. Crystallizing a pension really just means that you start taking your pension benefits. So crystallizing in the old sense is really about, you know, making sure that it's sort of crystallized and it sort of stays in one place, but actually it's all about taking those benefits. So use that terminology when you hear sort of somebody saying, you know, crystallizing a benefit. It's just starting to take your benefits as well.
And another one for you, Bronwyn. What's the annual cost of care? So what are the estimates that you would use in your model?
Yeah. So at the moment, and this hasn't, we haven't updated these at the moment, but we usually work on residential of £1,000 a week, so £50,000 a year, and then the cost of nursing sort of increases to around about 78,000 as well. So I think that's really important, that so people know the distinctions, there as well. So there are the sort of two.
Great. And then we've had a question on how much does a review cost? I think what we'll do for that one, we don't do reviews as a one-off. We do offer it as an ongoing service. So when we send the follow-up to this webinar, we will put some details about the service that we offer and about the cost of that as well. I think that is all the questions we have. I'll just give it 30 more seconds just in case anyone has a last-minute question. Doesn't look as though we've got any coming in. Okay, we'll stop it there. So thank you so much for everyone for taking part and for sending all those questions in. We hope that was really helpful for you. We will be sending out a follow-up email with the guides that Bronwyn mentioned and a few other bits of information. But if you do have any follow-up questions, do send them in and we'd be very happy to answer those individually for you. Thank you for listening and have a lovely evening.
Thank you.